Welcome to Market Maverick Talks, a father and son podcast examining today's most innovative companies. Before we start, please make sure to read the full disclaimer in the notes below. We are not financial advisors, and anything we say should not be taken as formal advice or a formal recommendation. In today's episode, we will be diving into an under-the-radar company that Wall Street is quite favorable on. It's a high-yield and mid-cap, currently trading 35% off its highs set in January 2025, that should benefit from the explosive growth of data centers and the surge in demand for reliable sources of energy. Stick around to learn more about this company, Kodiak Gas Services. So Kodiak Gas Services is amongst the largest providers of natural gas compressor services in the United States. A tailwind for them is if natural gas production increases, their compressor services are utilized higher, which will drive increased revenue and earnings. So Kodiak Gas Services makes money really from two main customer segments, upstream and midstream. For upstream, the companies they work with are exploration and production companies like ExxonMobil or ConocoPhillips, especially in the Permian Basin. These compressors are necessary when there is not enough pressure for natural gas to move from the wellhead up to the processing facility. For midstream suppliers like Phillips 66 and Energy Transfer, these compressors are necessary to move the natural gas through the pipelines. Kodiak Gas Services charges a fixed fee based on the utilization of their compression services. Now, to look at their current financial conditions, I'll be looking at Q4 2024 versus Q1 2025. The reason I'm not comparing year over year is Kodiak closed a large acquisition in April 2024 that will make the Q1 2024 numbers look artificially low. So looking at revenue, it looks about flat. It only went up 6% quarter over quarter. But net income increased by 36% quarter over quarter, driven by record adjusted EBITDA numbers of $177 million. For a mature company with costly assets that depreciate, looking both at net income and adjusted EBITDA will give me the best feel of their current financial health. Looking at their full year 2025 guidance, Kodiak is calling for adjusted EBITDA for $695 to $725 million, which compared to full year 2024's $610 million is a 12 to 19% increase year over year. For key things to monitor, the first is going to be the natural gas prices and volumes. Kodiak Gas Services growth is dependent on natural gas volumes continuing to increase. Second, to evaluate financial health, I'll be keeping an eye on their dividend rate. They just raised their dividend by 10%, but I really want to see in the quarters ahead if this company will be able to ride this tailwind to continue having the cash flow to pay such an attractive dividend. Looking at their stock chart today, July 25th, and it is trading around $31, which is at the midpoint of its 52-week low at $24 and the high at $50 set back in January 2025. Also, looking at the market cap, this company only has a market cap at $2.7 billion, so it's trading at a 4 to 5x expected 2025 adjusted EBITDA. And looking at that forward dividend yield, it's high. It's 5.6%, which would be great as long as they can continue paying it. Now I'm going to pass it off to my dad, John, to cover other metrics he looked at to evaluate Kodiak Gas Services.
Thanks, Scott. Yes, for the technicals, which I usually look at. As you can see, the 50-day moving average is 34, and the 200-day is 37, and the price right now is 31 and change, so it's below both of them. So that's not a good sign that it's below both the 200, especially the 200-day that it's below. So as far as the last four quarters, 3 of the last 4 quarters, the earnings have missed. And generally speaking, the earnings are what basically the company tells the analysts. So if you miss the earnings that you tell the analyst, that's pretty bad. So anyway, 3 of the last 4 quarters have missed. And usually in the S&P 500, which KGS I don't believe is in, but usually in the S&P 500, 80+% beat the earnings. So that kind of tells you something. And then the debt to equity is 190%. That means they have more debt than they do equity, total equity. And usually it should be below 25%. So that's another bearish sign, so to speak. So my views are that just looking at the things I look at, my analysts that I look at, two are strong buys, two are buys, two are holds, and one is a sell. So the analysts seem to differ than my thoughts. Earnings comes out after the market closes on August 11th, and basically, I would say that I would avoid Kodiak. I would avoid it for something in the energy sector. An ETF called XLE, X-Ray, Larry Edward, is an ETF of energy companies, and take a look at that. And also, ExxonMobil is my go-to, but the price I think is a little high right now, so I would just wait a little bit on ExxonMobil. But those two companies are the ETF XLE and XOM are my go-tos for when I want to buy energy and such. So I would avoid Kodiak Gas Services, and now I pass it back to my son, Scott.
So I do like the play on energy scarcity for data centers, especially since other key vendors for data centers like Veritas Coolant System, Arista Network Switches, and EM Core for construction have all soared. However, right now should be a golden period for Kodiak with natural gas volumes at super high levels. But despite this, there are doubts that they can continue paying their dividend with such a high debt load, and its adjusted EBITDA is only growing 12 to 19% a year. For energy providers at data centers, there's others I prefer to look at, similar to you. Personally, I'm going to look at Brookfield Renewable, which has signed power purchase agreements with both Google and Microsoft. Google, I believe, is at least the next 20 years. So it's very long term, very predictable revenue streams. And Brookfield has consistently shown they can increase their funds from operations and their dividend by 5 to 9% per year. Both Kodiak and the Brookfields have high dividend yield and also exposure to the energy scarcity tailwind. But I think from a balance sheet and a debt perspective, Brookfield seems to be the better option here to, to really play this tailwind. To summarize, I'd say we both agree that looking at energy providers could be a good long term trend for our portfolio. Natural gas seems like will be part of the solution for reliable and clean energy sources to enable continued data center growth. However, we both prefer to look elsewhere for this tailwind to add to our portfolio. If you enjoyed this video, please consider liking, commenting, and subscribing to help us out as we aim to release weekly content about innovative, long term focused companies on this father and son podcast.